In this video, we're going to talk about what actually causes a market to move. So why does a market go up and why does a market go down? Well, the market is driven solely by liquidity. Simply the mass number of buyers and sellers at a concentrated point in the market. And what the market will do is it will try to match buyers and sellers together. And by definition, it always moves to the price point where the maximum number of orders can be matched. You also have to remember that liquidity is inversely proportional to volatility, which is why we see high liquidity at the start of a turn. What we have done is design an indicator that actually calculates liquidity. It's called the Liquidity Prophet Histogram. Let me put it on the chart. It's really amazing. So let's have a look, now that we've got the indicator on the chart, what's actually happening. We can see that we had a very high level of liquidity generated on the 27th of 10, 2023. And in fact, that was the largest liquidity that had been generated for ages. And that would have told you that perhaps this move to the downside had ended. And in fact, you could have traded all the way up based upon that. Now, if we look back in the past and we look for relatively high levels of liquidity, you can see here this one is head and shoulders above the other one, and it preceded that turn to the upside. Wasn't a massive turn, but that was a good couple of thousand points, and you certainly had a heads up that that market was going to change direction. Yeah, 1,800 points. So here you had another high liquidity, excuse me, just there, and that caught that fall. So you can see that the indicator's pretty darn good at finding turns in the market and giving you advance warning that these turns are actually going to take place. Because the histogram is calculating liquidity, mathematically it's always the same. So if you get a level of liquidity at that point there and you come along and you find another level of liquidity at the same point, mathematically those two levels are the same. So if we're looking for reversals in the market, what we need to do is go back into the past and then find the levels of liquidity based on the histogram where the market turned previously. So I can take this level here because that was a good turn, and you can see how close these levels are. That one exceeded a little bit, so did that one. But these are all telling you that, relatively speaking, when you get these sorts of levels of liquidity printed by the histogram, you should be careful that the market is not going to turn on you. So here, just before that little fall there, let me make that larger. You can see just before that fall there, we got a relatively high level of liquidity, and indeed the market fell for 2 days. Now, as we go up again, you can see we're starting to print high levels of liquidity, which is telling you that this market is likely to make a reversal within the next couple of days. So let's now get into the interesting part of how you actually trade using this indicator. Well, the market nearly always comes back for a second bite of a cherry at the turn in order to absorb all the liquidity at that level, which is why the best move to trade is the second retest of either the high or second retest of a low, and it's a low liquidity move. It's a low liquidity move because the market is just going back there to mop up that liquidity which it missed first time round. So basically what we're looking for is a high level of liquidity being generated, and then on the next bar a low level of liquidity being generated. So you can see here at this top that you got high level of liquidity. On the next bar, which was this one, you had a low level of liquidity, so that would have been a sell. On this bar at this low, you had a high level of liquidity. The next bar was a low level of liquidity, so that was a buy. The thing is, you only get the liquidity print at the end of the day, so once you get the lower liquidity print, that's your entry. You can enter on the close of that next candle. Similarly here we had high liquidity followed by low liquidity, so you would have gone long on the close of that bar there. And don't forget, this is a daily chart, so you only have to look at your indicator every day and just decide, do we have a lower liquidity print, and then you know to get in. You can see here that was a perfect example. High liquidity at the top and then low liquidity, and you would have sold there. Now, how long do you hold your trade? Well, you can see that you basically just hold your trade until you get a high liquidity print. And in this case, you would have gone short here. You would have closed out here on the close, 2,000 points. At this point, we had no indication that we were to go short. We just had low liquidity, so you wouldn't have caught that move. But here you would have caught this, and you've just ridden it all the way. Similarly, with this move here, we had high liquidity coming in just one bar before, and then low liquidity. You would have been able to enter on that, and it's only one's guess as to how you would have decided how long to hold it, because we didn't really get high liquidity until that point there. So you would have got out there 1,400 points, and you don't always get a liquidity signal at a turn. Sometimes they just don't come along, but it doesn't matter, because mostly they do come along, and you only have to just go with the probabilities that high liquidity, low liquidity, enter into the trade, and then you're looking for high liquidity to get out of a trade. We also have a second indicator. It's called the Liquidity Profit Map. And what this does is it gives you advanced warning by drawing colored candles on your chart, so it tells you that liquidity is coming into the market. Let me put it on the chart for you. So we say indicator, Liquidity Profit Map. Let's just put that on. And what I'm going to do is I'm going to set the sensitivity to high and just leave everything else as it is. It's got more functionality than this, but we can go into that a little bit later. So let's put that on the chart and see what it does. So you can see as we came up into this top here, we had the liquidity profit map showing us that the liquidity was increasing, but the histogram only gave us a reliable signal at this point here. Now this one, again, colored candles, one bar later, we went up. This actually caught this little top here, but I wouldn't have actually taken that trade because we wanted liquidity on the histogram to go above this level. And sure enough, when it did, you got the colored candles. As this market fell, you can see we get colored candles, but we don't actually get a high level of liquidity, so we don't take the trade until this one here. But the colored candles actually give you advance warning that something's going to happen. As this market moves down here, we get colored candles, but we don't get a drop in the actual liquidity histogram, so you're not looking to go long until you see that drop. So let's see what conditions you need for a trade. And it doesn't matter whether it's a buy trade or a sell trade, it's always the same. Firstly, we need colored candles on the chart. This indicates that liquidity is increasing. It doesn't mean you take a trade, but it means be aware. The next thing you look at is the liquidity histogram. Is it at a level that previous turns have occurred at in the past? Because previous liquidity turns are where you should be trading. And three, the last thing is, the histogram must print a lower level on the next candle. So that would be a typical lower level on the next candle, something like this. But what you really want to see, the drop in liquidity, is telling you that the large players, the big institutions, the big banks, the big hedge funds, are no longer buying or selling at that level, i.e. they filled their books and they're prepared to let the market run. So if you're interested in the indicator, please get in contact. The email is helpmetradenow@gmail.com. We're making both indicators available for a really great price. We have two options available. You can pay for the indicator on a monthly basis. It's just £79 a month. The other option is that you sign up for 12 months, but you only pay us for 10. And the even better news is that every time we add extra features and functionality to the indicator, you automatically get the upgraded version.